The Federal Reserve just announced that it will be buying T-bills on an ongoing basis, a move that many analysts immediately linked to the early stages of a new liquidity cycle. According to several research desks, this type of announcement often looks mild on the surface, but QE by any other name still behaves like inflation. And what happened today could possibly be the first step that pushes the system toward a much larger shift. If the Federal Reserve expands its T-bill program into a full-scale QE5 during late December 2025, gold and silver would likely react in dramatic ways. According to analysts who study long-term monetary patterns, many of them warned that when short-term purchases begin without a clear end date, long-term rates often rise because private investors expect the currency to weaken. As that pressure builds, officials usually face demands to expand operations into longer maturities, creating the same chain reaction that earlier easing cycles produced. As balance sheet expansion grows, traders often assume that liquidity will flood the system faster than economic output can absorb it. According to several bond strategists, this dynamic pushes long-term yields upward until the institution begins buying longer-dated bonds. Some insiders allegedly believe that discussions about extending purchases across the curve are already happening behind closed doors. And that is why they expect QE5 to stretch well beyond short-term paper. When these conditions form, gold often becomes a preferred shelter because it cannot be diluted. As soon as investors sense that inflation pressure is building through repeated balance sheet growth, gold tends to climb steadily. According to commodity specialists, this could push gold toward a strong multi-month rally, especially if real yields fall deeper into negative territory. Some analysts allegedly believe that if QE5 accelerates, gold could surge throughout January 2026 as investors prepare for more liquidity. Silver would likely react even more aggressively. Historically, silver responds to easing cycles with sharper percentage gains because it is tied to both investment demand and industrial demand. According to market observers, when gold rises during inflationary phases, silver often races ahead in quick bursts, especially when traders believe that longer-dated QE is coming. If long-term rates rise and QE expands, silver could move in fast waves each time new liquidity measures are announced. By early January 2026, the combination of expanding balance sheet activity, rising inflation expectations, and weakening real yields could create a powerful rally across both metals. Analysts who track historical patterns say this type of sequence has repeated many times over the past 2 decades. What happened today, according to those same analysts, looks like the opening move in that familiar pattern. Overall, if QE5 expands the way many fear, gold would likely rise steadily, while silver becomes the high-speed version of the same trend. The question circulating across trading desks is simple: got gold? Disclaimer: this is for educational purposes only and is not financial advice.